Hey everyone, and welcome back to our channel. In this video, we are taking a closer look at Mapletree Pan-Asia Commercial Trust, often referred to as MPACT. This is a prominent player in the Asian real estate landscape. We are going to break down its recent financial performance, discuss its strategic decisions, and examine the broader market conditions that influence its operations. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. First, what exactly is MPACT? It's a Singapore-listed real estate investment trust that was formed in July 2022 through the merger of Mapletree Commercial Trust and Mapletree North Asia Commercial Trust. MPACT manages a diversified portfolio of 17 commercial properties spread across 5 key Asian markets: Singapore, Hong Kong, China, Japan, and South Korea. Its primary focus is on acquiring and managing income-generating real estate, mainly for office and retail purposes. A key characteristic of MPACT is its relationship with its sponsor, Mapletree Investments Private Limited. Mapletree Investments, a global real estate powerhouse, holds a substantial 56% stake in MPACT and oversees a colossal 80.3 billion Singapore dollars in assets as of March 31, 2025. This strong backing indicates a robust support system and a close alignment of interests between the manager and its unit holders, which can be particularly relevant during periods of market volatility. Now, let's examine MPACT's recent financial performance. For the financial year ended March 31st, 2025, financial year 24-25, MPACT reported a notable decline in its financial results. Gross revenue saw a 5.1% decrease, falling to 908.84 million Singapore dollars from 958.09 million Singapore dollars in the previous year. Net property income also experienced a 6.1% reduction, coming in at 683.54 million Singapore dollars. Perhaps the most significant impact was on its distribution pay unit. MPACT's DPU for financial year 24-25 declined by a substantial 10% year to 8.02 Singapore cents, down from 8.91 cents in financial year 23-24. The fourth quarter, Q4 financial year 24-25's DPU showed an even sharper 14.8% decrease. This reduction was primarily influenced by lower contributions from overseas properties and adverse foreign exchange movements. The strengthening of the Singapore dollar against currencies like the Japanese yen, Hong Kong dollar, and renminbi significantly reduced the reported overseas earnings when converted back to SGD. This suggests a structural challenge within MPACT's portfolio outside of Singapore. In terms of capital management, there have been some positive developments. MPACT's aggregate leverage ratio improved to 37.7% from 40.5% in the previous year. This reduction in gearing was a direct positive outcome of the strategic divestment of Mapletree Anson on July 31, 2024. Finance expenses also saw a slight decrease. However, the interest coverage ratio slightly decreased to 2.8 times from 2.9 times. This metric is sensitive with a 100 basis point increase in weighted average interest rates, potentially lowering ICR significantly to 2.2 times. This indicates MPACT's ongoing sensitivity to rising interest rates. Looking at valuations, MPACT's net asset value (PA) unit was 1 Singapore dollar and 78 cents as of March 31st, 2025. The trust's current price-to-book ratio stands at 0.71, which is below its historical average of 0.81. APB ratio below 1.0 often indicates that the market is valuing the company's assets at less than their stated book value, potentially suggesting undervaluation or underlying concerns about asset quality. A key factor contributing to this valuation difference is the significant revaluation losses in some of its overseas assets. For example, an off-cycle valuation on 3 Japan office assets resulted in an 18.6% revaluation loss in local currency terms. The Fujitsu Makuhari building alone experienced a substantial 40.9% decline due to a key lease non-renewal and general market softness. These are not merely accounting adjustments, they reflect a tangible decline in asset value. MPACT's management has been actively engaged in strategic initiatives to optimize its portfolio. The divestment of Mapletree Anson was a key move in capital recycling that positively impacted its financial ratios. Notably, there are ongoing discussions about potentially exploring a merger or sale of Festival Walk, a significant asset in Hong Kong, with the goal of making the trust more Singapore-centric. This suggests a strategic shift to leverage the stronger domestic market and reduce exposure to more volatile overseas assets. Additionally, VivoCity, a major retail destination in Singapore, is undergoing asset enhancement initiatives, which are expected to boost its performance. VivoCity and Mapletree Business City are already strong anchors, contributing a disproportionately higher share of NPI, 59%, relative to their AUM, 54%. The management fee structure, which includes a performance fee linked to DPU growth, provides a strong incentive for management to address the DPU decline. Actions like the Mapletree Anson divestment and the potential Festival Walk sale are seen as direct responses to this incentive structure. MPACT is also considering a unit buyback mandate, which, if executed, could enhance DPU and NAV per unit by reducing outstanding units, potentially signaling management's confidence. Now, let's consider how the market is reacting to MPACT. As of July 5th, 2025, MPACT's unit price was SG $1.26. Over the past year, it has significantly underperformed both the broader Singapore stock market, which saw a 15.9% return, and the SG REITs industry with a 9.3% return. This suggests a prevailing cautious or negative market sentiment. Despite this underperformance, analyst sentiment remains notably positive. Various financial institutions, including Maybank Securities UOB Kay and DBS Group Research and OCBC Investment Research, have indicated favorable outlooks for MPACT. Their collective price targets suggest a considerable potential for unit price appreciation, with a consensus estimate of SGD 1.514 representing 20.2% above the current unit price. This positive perspective from analysts seems to anticipate the positive effects of recent divestments, the continued strength of MPACT's Singapore-based assets, and an expected broader rebound in the Asia-Pacific real estate sector. However, MPACT operates within a complex macroeconomic environment. While the broader Asia-Pacific commercial real estate market is expected to see modest improvement in 2025, driven by resilient regional economies and anticipated lower interest rates, there's a flight to quality trend that may primarily benefit prime assets. This could mean that MPACT's non-prime or older overseas assets may continue to face challenges. Globally, economic growth is projected to slow and persistent inflation risks remain. MPACT is subject to a double whammy effect from adverse currency movements and rising interest costs. The weakness and revaluation losses in overseas markets, particularly Japan, remain a persistent challenge. MPACT also faces intense competition within the REIT sector and is noted as trading at the worst valuation among STI constituent REITs. On a positive note, MPACT maintains a favorable environmental, social, and governance profile with a low risk rating, ranking commendably in its industry. This commitment to sustainable practices is expected to enhance its long-term resilience and appeal to ESG-focused investors. So, what are the key points to consider about MPACT? While MPACT presents an attractive valuation, trading below its book value with a 6.4% dividend yield higher than its historical average and benefits from strong sponsor backing, the significant 10% DPU decline in financial year 24/25, and the persistent underperformance of its overseas assets due to operational weakness and adverse foreign exchange movements as significant aspects to observe. Analyst optimism is present, but it largely anticipates a future recovery that is not yet fully evident. Strategic rebalancing efforts are underway and are seen as positive steps, but their full impact is still unfolding. The broader macroeconomic uncertainties, from global slowdowns to varying interest rate trajectories, add another layer of complexity. Therefore, for those monitoring MPACT, observing for clearer signs of stabilization and sustained recovery would be prudent. Key indicators to keep an eye on include a definitive bottoming out and subsequent reversal in DPU trends, tangible improvements in the operational performance of its overseas portfolio, including increased occupancy and positive rental reversions, successful execution of strategic rebalancing efforts, demonstrating that divestments and asset enhancements genuinely contribute to unitholder value. Keeping a close watch on the upcoming Q1 financial year 25-26 results due on July 30th, 2025, will provide concrete evidence of these developments. A clearer and more consistent positive trajectory in these areas would offer a stronger foundation for understanding MPACT's future path. That's our detailed look into MPACT. If you found this information valuable, please like, share, and subscribe for more insights. We'll see you in the next video.